Okay, let's talk about monetary policy and how it affects interest rates. Okay, so interest rates again is the price paid for the use of money. There are many different interest rates out there. However, for simplicity's sake, we are just going to assume one interest rate. And the interest rate is determined by money supply and money demand. Okay. Demand for money comes from people wanting to hold their money in liquid form, meaning in cash or in checkable deposits ready to use. And there's two reasons for this. The first one is, you know, they want money in order to be able to conduct their day-to-day transactions. They need money in their checking account or as cash in order to buy gas, to buy food from the grocery store, for example, etc. And this is determined by nominal GDP. The higher nominal GDP is, and the more money people have to hold as cash or checkable deposits, because their wealth tends to be higher, and also price levels are higher too usually, and when things are more expensive, people need to hold more money in liquid form in order to be able to buy the same amount of goods and services. So transactions demand is independent of the interest rate. And then the other reason is asset demand. And this would be using, whenever someone buys an asset, money would be then used as a store of value. And this varies inversely with the interest rate. So the lower the interest rate is, then the lower interest assets pay to the holder. And so there's less of an incentive for households to buy assets when the asset isn't really paying them much money. And then the opposite is true when interest rates are higher, then the assets are paying households a nice return. And so households tend to hold a lower quantity of money in cash when interest rates are higher, and they tend to hold more of their money instead in assets. Okay, so for example, if a interest rate for savings is 8%, then households would put their money more in savings account rather than holding it in checkable deposits, because the opportunity cost of holding your money in a checking account versus a savings account is high. You're foregoing 8% return on your money. However, if interest rates are what they are around now, like 0.1, 0.2, 0.3%, which is incredibly low, then the opportunity cost of holding your money as cash is not so high. Okay, and so households tend to hold a higher quantity of their money in liquid form when interest rates are low. Okay, and so transactions demand for money plus asset demand for money equals the total demand for money. So you could see here that transactions demand for money is dependent on nominal GDP, not at the interest rate. So it doesn't matter what the interest rate is. Demand for money for transactions is vertical. Again, this is the money that you demand in order to be able to buy your day-to-day goods and services. Asset demand for money, does depend on the interest rate, because this shows how much money you demand in order to buy assets. Okay, so at lower interest rates, for example, a household would demand to hold more of their money as cash than at, let's say, higher interest rates. Okay, because when interest rates are low, then the opportunity cost of holding your money as cash is also low. You're not foregoing a lot of interest. So we demand a higher quantity of money in liquid form, either cash or checkable deposits. But when interest rates are high, the opportunity cost of holding your money as cash or in checkable deposits is higher, because you're foregoing interest. So what households tend to do is hold less money in liquid form, meaning they hold less money in their checking account, less money in cash, and they buy more assets with it. They might put it in savings accounts, buy bonds, buy stocks, etc. And then the total demand for money is the sum of transactions demand for money plus asset demand for money, and then the interest rate is determined by where the supply intersects the demand curve. So you can see at 5% interest over here, okay, transactions demand for money is $100 billion. And then asset demand for money is another $100 billion. So we have $200 billion over here, and that's where supply of money intersects. And that determines the equilibrium interest rate, where supply of money intersects demand for money. And again, what forms the money demand curve is transactions demand for money added to asset demand for money. Okay, so the equilibrium interest rate will change with shifts in money supply and money demand. Monetary policy aims to change interest rates by influencing money supply. So it aims to shift the money supply curve. All right, let's talk a little bit about interest rates and bond prices. They are inversely rated, so the higher the bond price is, the lower the interest rate is, and then vice versa. Okay, so a bond pays a fixed annual interest payment. So let's say this bond pays $50, okay, in their annual interest payments. And if the bond is $1,000, then the interest is 5%. Okay, but if the interest rate were to go up to 7.5%, then the $1,000 bonds aren't really sellable anymore. They're not tradable because it looks like they're only giving a 5% interest. So what ends up happening is the bond price falls. Okay, in this case to $667. Okay, because remember, it's making a fixed annual interest payment, so no matter what, it's going to pay $50. Okay. So since the numerator here is fixed, in order for the interest rate to go up, then the price has to fall, and then vice versa. If the interest rates fall, then the price has to rise. Okay. So long story short, when bond prices rise, interest rates fall. When bond prices fall, interest rates rise. Okay. So if you look at the Federal Reserve balance sheet, there are assets. We can see securities and loans to commercial banks. Okay, so the securities consist of treasury bills, treasury notes, treasury bonds. Okay, the difference between the three is the length of time. Treasury bonds are long-term security, notes are midterm, and bills are short-term. And then they also have loans to commercial banks. Okay, so the Fed does act as a lender to banks, and so any loans they make to banks will go to the assets category. And then liabilities, they have the reserves of commercial banks. So whether it's actual reserves or excess reserves, they can be stored at the Federal Reserve Bank, and the Federal Reserve pays interest on those. Also, Treasury deposits. Okay, so the U.S. Treasury keeps deposits there and then draws checks on them to make payments. And also, Federal Reserve notes outstanding. Basically, any money that's in circulation is counted as a liability. Okay, and when I say money, I mean cash, paper money. Okay, so you can see the Federal Reserve balance sheet in 2013. Okay, securities were $957 billion worth. Loans to commercial banks were $439 million, and then all other assets were $271 billion. Okay, and then on the liability side, reserves of commercial banks, $1.8 trillion. Treasury deposits, $52 million. Federal Reserve notes outstanding, $1.1 trillion, and then all other liabilities, $188 billion. Okay, so you can see here central banks around the world. Okay, so here are their official names. Australia is the Reserve Bank of Australia. Canada's Bank of Canada. The Eurozone. Okay, a lot of countries, when they decided to go or rather adopt the euro as a currency, then they gave up control of their own national currency to the European Central Bank. So they gave up their own currency and adopted the euro, and now all the control is European Central Bank. Then we have Bank of Japan, Banco de Mexico or Mexbank, Central Bank of Russia, Riksbank, Bank of England, and the U.S., it's called the Fed. Okay, so the Fed has several tools to conduct monetary policy. The most important one and the most used one are open market operations. Okay, and this is the buying and selling of government securities or bonds to influence the money supply. And so they can buy and sell these bonds from banks and to the general public. Okay, and if you remember, banks create money through loans, and they loan out money from their excess reserves. Okay, so when the Fed sells securities, then commercial banks buy them, pay that money from their reserves, and therefore their reserves are reduced. And then the opposite is true too. When the Fed buys securities, okay, they pay the bank money in exchange for the securities, and the bank's reserves are increased. Okay, so here Fed buys bonds from commercial banks, and so what happens is that, okay, it's a reduction in those securities, okay, from commercial banks, and so that goes into the assets of the Federal Reserve Bank. Okay, and then the Federal Reserve Bank pays the commercial banks with their reserves, which goes as an asset to them. Okay, when the Fed sells bonds to commercial banks, then the Fed sells securities, so it's taken away from their assets and goes as an asset to commercial banks. The banks pay for these securities with their reserves. Okay, and then there's a reduction in the liabilities. Okay, you see here the minus. So there's a reduction in the liabilities column for Federal Reserve banks. Okay, so let's say the Fed buys a $1,000 bond from a commercial bank. Okay, and let's say here that the money multiplier is 5. Okay, so what ends up happening, as we saw a couple slides back, is that the Fed deposits the $1,000 payment as reserves to the commercial bank. Okay, it immediately credits the reserves. Since this is technically not a checkable deposit, the bank can lend out the full amount of $1,000. Okay, they're not required to hold a minimum in this case, and so they can lend out the full amount, $1,000, and through the multiplier, okay, we get that the money supply can increase to $5,000 from the original $1,000 increase in reserves. Okay, so when the Fed buys $1,000 from the public, then the public gives securities to the bond. The Fed gives $1,000 check to the public. The public then deposits that check in their bank, and since it's a checkable deposit, then they have to hold a certain amount of required reserves. In this case, the required reserve is 20%, so they have to hold $200 as required reserves, and then they can lend out the $800 in excess reserves. Okay, and again, if the multiplier is 5, okay, we get $4,000 created from the bank lending system. And then if you add the initial $1,000 deposit, total increase in the money supply is $5,000. All right, other tools of monetary policy is the reserve ratio, and this is how much banks are required to hold in checkable deposits as reserves. So, the higher their reserve ratio is, the less money that can be lent out from checkable deposits, and therefore the lower the money multiplier will be. And then the lower the reserve ratio will be, then the less money banks have to hold, which means they can lend out more of their checkable deposits, and the money multiplier increases in this case. Okay. And the discount rate, so the discount rate is the rate that the Fed charges banks for them to borrow money from the Fed. The Fed acts as a lender of last resort and makes short-term loans, and it does not do this for free. It will charge the interest rate called the discount rate. The higher the discount rate, then the less short-term loans a bank will borrow, meaning the less reserves they will have to lend out. And the lower the discount rate is, and the more money that banks will borrow, and the more reserves banks will have to lend out. And then term auction facility, this is new. This was introduced the end of 2007, try to help stabilize the financial markets. This is where any reserves held at the Federal Reserve are paid interest. And so if the Fed wants to decrease the money supply, then they will pay a higher interest at reserves kept with them. That way banks will instead keep reserves with Fed banks and earn interest instead of lending that money out, which would increase money supply. And then vice versa, if the Fed wants the money supply to increase, then they will lower the interest rate on reserves kept with them, and that gives an incentive for banks instead to lend out those extra reserves, which again increases money supply. Okay, so we look here at effects of changes in the reserve ratio. If reserve ratio is 10%, checkable deposit is 20,000. Okay. We see that money creating potential of banking system is 30,000. Okay. Notice that in each of these scenarios, checkable deposits is 20,000. Okay, so if its reserve ratio is increased to 30%, then the money creating potential of banking system is actually negative over here. So we can see the effect of changes in the reserve ratio. Lower reserve ratios increase money supply, higher reserve ratios decrease money supply. Okay, open market operations is the most powerful and most used tool. The reserve ratio is very rarely used. It can be very disruptive, as you've seen in the last slide, to the banking system, and it's harder to implement. The last time it was changed, it was 92. Discount rate is a more passive tool. The Fed changes it just to keep in line with other interest rate. However, it did come handy with the financial crisis 07-08, where the banks drastically lowered the discount rate in order to allow commercial banks to borrow billions of dollars in order to stay liquid. And then interest on reserves, again, is a newer tool of monetary policy, but really open market operations is our main focus. Okay, so open market operations target what we call the federal funds rate. The federal funds rate is a rate charged by banks on overnight loans. So one bank can give another bank a loan and charge them interest on that loan, and that's the federal funds rate. And so, like I said, the Open Market Committee conducts open market operations to target the federal funds rate at a certain level. And where the demand curve for federal funds intersects the supply curve for federal funds, that is where federal funds rate is determined. Okay, the demand for federal funds rate is downward sloping. because the lower the interest rate is, then the higher quantity of federal funds that a bank will demand, since they're paying a lower price to borrow that money. And then the higher the federal funds rate is, then the lower quantity of federal funds that banks will demand from other banks, because the cost of borrowing that money is now higher. And banks, borrow money from each other overnight because sometimes they're a little short on their reserves. So instead of going to the Fed, it's easier for them to go to another bank. And so we see here demand slipping downward, and then the supply here, it's horizontal. But the reason it's horizontal is because the supply of federal funds is determined by the demand. So if demand for federal funds is QF3, then the Fed will supply at QF3. Okay. And if the demand for federal funds is QF1, then the Fed will supply here at QF1, and so on. Okay, and then what we see is that whatever direction the federal funds rate goes, the prime interest rate goes. And the prime interest rate is the benchmark interest rates that's used by banks as a reference point for other interest rates. And so if federal funds rate goes up, then prime interest rate goes up. If federal funds rate goes down, prime interest rate goes down. So essentially, federal funds rate goes down, prime interest rate goes down, which means interest rates to borrow go down, interest rates to save go down, etc. So the Fed, when they want to expand the economy, then they engage in expansionary monetary policy. And, they use this during times of recession or very slow growth. And so they want to lower the federal funds rate. The Fed will then buy securities. And so we see that when the Fed buys securities, the reserves of banks increase. That then banks have more money to lend. That increases the money supply. And that puts downward pressure on interest rates. And when interest rates drops, then investment rises. Okay, so aggregate demand will shift to the right. And we'll do a couple of graphs on that. Okay, so restrictive monetary policy, or in other words, contractionary monetary policy, will do the opposite. This is used by the Fed in times of rising inflation to prevent asset bubbles. Okay, so the Fed will sell securities. This will decrease the reserves of banks. Less money to lend decreases money supply, increases federal funds rate, increases interest rates, which would then lower investment, and that shifts aggregate demand to the left. All right, so we can see here that whatever direction the federal funds rate goes, the prime interest rate will follow. Okay, so we don't see the federal funds rate directly in our daily lives, but we do see the effect the federal funds rate has through the prime interest rate. So when we go take out a loan to buy a car, for example, or when we put money in our savings account, and the interest rate we earn there, okay, is one that has followed the direction of the federal funds rate. And you can see here in response to the Great Recession how low interest rates have gone. Okay, so the goal of the Fed is to have low inflation and full employment. And so they will adjust the rates when needed to reach their goals. And so if there's a consensus among the Federal Open Market Committee members that, a change is needed, then they'll set a new target rate and adjust policy to meet that target rate. So John Taylor, economist, suggested a rule of thumb, and the Fed actually seems to follow this policy quite closely. So it starts with the assumption that the Fed's target rate of inflation is 2%. Okay, because the Fed is willing to have a little bit of inflation for a trade-off of full employment. Okay. So when real GDP equals potential GDP and inflation is at its target of 2%, then the federal funds rate should be 4%. Okay, that's the nominal federal funds rate. If we minus the 2% inflation, then the real federal funds rate is 2%. Okay. So for every 1% increase of real GDP above potential GDP, okay, so this would be when the economy is in expansion, the Fed should raise the real federal funds rate by 0.5 percentage point. And for every 1% increase in the inflation rate above its 2% target, then the Fed should raise the real federal funds rate by 0.5 percentage point. Okay. So, and then you could also argue for the reverse. If real GDP is, for every 1% decrease of real GDP below potential GDP, okay, then the federal funds rate should be lowered by 0.5 percent. And then also when inflation falls short, for every 1% it falls short, then it should be lowered by 0.5 percentage point, the real federal funds rate. Okay. And they can, do both at the same time. So for example, if GDP is 1% above potential GDP and target inflation or actual inflation is 1% above the target rate, then the Fed should increase the real federal funds rate by 1% total. Okay, so the next couple of slides, we're going to graph out the effect on real GDP and price level, and also what happens to investment, the interest rate, and aggregate demand. Okay, when we have expansionary monetary policy and restrictive monetary policy. Okay, so first let's look at expansionary monetary policy. All right, so what we have here is the Fed wants to increase the money supply. Let's say we are in a recession and the Fed wants to increase the money supply to lower interest rates. Okay, so we go from SM1 to SM2. Okay, and we see here that interest rates over here, okay, fall. So we go from 10% to 8%. Okay, so the quantity of investment demanded rises because now the cost of borrowing money for investment purposes is lower with a lower interest rate. And aggregate demand shifts to the right. And we are now at price level 2 and at our full employment level of output. Okay, let's model a case where restrictive monetary policy is needed. So let's say the economy is at SM3. Let's say it's in an inflationary period. GDP is above full employment output, and the Fed is concerned about inflation. So in this case, the Fed's going to want to decrease the money supply by selling securities, and that way interest rates will rise. So what we see is we're at 6% interest rate over here. Money supply shifts to the left. Okay, interest rates rise to 8%. So we were at $25 billion of investment demand over here. And now that interest rates are higher, the cost of borrowing is higher, so investment demand falls to $20 billion. Okay, and we see that aggregate demand shifts back to the left. We'll model this in the next slide. Okay, so the economy was here at AD3, this highest point over here, which was above full employment GDP, and with restrictive monetary policy, it increased real interest rates, investment dropped, and remember, investment's a component of aggregate demand. So if investment decreases, aggregate demand shifts to the left, and we end up here at AD4 and at full employment output. Okay, so long story short, if there's recession and unemployment going around, Fed buys bonds. They can also lower the reserve ratio, the discount rate, and increase reserve auctions, but most likely the Fed's going to just buy bonds. Okay, excess reserves increase, federal funds rate falls, money supply rises, interest rate falls, investment spending increases, aggregate demand increases, and then real GDP rises and unemployment falls. For restrictive monetary policy, okay, this will be used in times of high inflation. The Fed can sell bonds, increase reserve ratio, increase discount rate, or decrease reserve auctions. Okay, most likely they'll just engage in open market operations, which means they'll just sell bonds over here. Excess reserves decrease, federal funds rate rises, money supply falls, interest rate rises, aggregate spending decreases, aggregate demand decreases, and inflation declines. Okay, so the advantage of monetary policy over fiscal policy is, first, it's much faster to implement. It just depends on the agreement of the Fed chairman and the Federal Open Market Committee members, whereas fiscal policy, you have to wait for all of Congress to agree, and it takes longer time to pass bills. Also, it's more flexible. Because of the way the Fed is structured, it's more isolated from political pressure, whereas members in Congress sometimes promise the public to do things that are counterintuitive economic-wise. And it's also more subtle than fiscal policy. Fiscal policy, the change in taxes, change in the distribution of resource, etc., is felt more by the public, whereas, when the Fed decides to target the federal funds rate, it's not as obvious at first. Okay, so monetary policy has been very active in recent decades. With the dot-com bust, the Fed immediately acted by lowering interest rates. After September 11th, it lowered interest rates even further. And then, of course, with the recession of 07-08, interest rates went to historic lows. And a lot of critics say that one of the factors that led to the financial crisis of 07 was that the federal funds rate was so low that institutions wanted to make, they didn't want to buy government bonds. They didn't want to put their money, rather, in government bonds because the interest rate was so low, and, that led them to engage in riskier behavior for higher returns. After the recession, it took a long time for unemployment to go down. It was just stuck in the 9 to 10% range for quite a while. And the Fed tried new and innovative ways to help stimulate the economy. One is they went to a zero interest rate policy. They, kept short-term interest rates very close to zero in order to stimulate the economy. So when you heard, this was the cheapest time to buy a house, that was true. A zero lower bound problem. Okay. This happened because the zero interest rate policy didn't generate as much growth as the Fed would have liked. And if they lowered interest rates any further, then nominal interest rates would be negative, meaning that the bank will be penalizing you for putting your money in savings there. And what they didn't want is to have negative nominal interest rates to where people stop depositing their money in the bank. Okay, that would be very bad for the economy, and banks would have a lot less money to lend out to consumers and businesses. So to deal with the zero lower bound problem, the Fed then engage in what is called quantitative easing. It actually went through several rounds of this, QE1, QE2, QE3. And so quantitative easing from the outside seems like open market operation, buying and selling of bonds in order to increase reserves. But it differs is that it was designed to not affect interest rates. The Fed didn't want to decrease interest rates any further. So the Fed allowed the buying of bonds with the sole intention of just increasing the quantity of reserves in the banking system. And interest rates were kept the same. And also it expanded just from buying bonds to also buying debt by government agencies and government-backed corporations. Okay, so it opened up the market, if you will, for securities a little bit. And then they engaged in what's called a forward commitment. And this is where they would not say how long each policy would last, how long they would hold out to it. They basically wanted the banks to know that the policy wasn't going to be reversed anytime soon. And so for them to not have so much fear that it would be reversed, that they wouldn't lend out the excess reserves. And then we had Operation Twist. It's a continuation of the forward commitment. And, the Fed said that they would purchase an additional $677 billion in long-term government bonds while selling short-term government bonds, and this resulted in reducing long-term interest rates. Some problems with monetary policy, just like fiscal policy, there's the recognition and operational lag, but these are much shorter than fiscal policy. Monetary policy can be decided within a few days. Fiscal policy takes much longer. Also, monetary policy may not be as effective because, just because the Fed, for example, lowers interest rates to stimulate growth doesn't mean that firms and people will take out loans for investment purposes. And indeed, we did see that during the Great Recession when, the business environment was very uncertain. People, even though interest rates were record low, everyone was hesitant to borrow money for investment purposes. And also, a liquidity trap can result. And indeed, it did happen in 2008. And this is when the Fed increases reserves of banks, but for various reasons, in the case of, 2008, banks were so worried about not getting paid back, since so many other institutions went bankrupt over not getting paid back, that they didn't really lend their money. They were just sitting on their reserves or keeping it in the with the Fed. And so therefore, despite the Fed engaging in expansionary monetary policy, the effect on aggregate demand and investment is very little, because banks just are not lending it out, or households and businesses are not demanding it. Okay, so in the big picture, monetary and fiscal policy affect aggregate supply the most through business taxes, subsidies, government regulation, and aggregate demands affected by monetary policy with interest rates, and also by fiscal policy with tax levels. Consumption, fiscal policy affects aggregate demand through tax levels, and then net exports, fiscal and monetary policy affect net exports, and then government spending, of course, that's affected by fiscal policy. And then all of those affect, again, aggregate demand. All right, this concludes chapter 34.